With the latest, here's Manus Cranny.
Jonathan, it's a quartet of good news, and it's a triptych in FICC. Citi has delivered FICC sales and trading of $3.48 billion. The estimate was just under $3 billion at 2.94. So that just shows you, again, the musculature of FICC, the good vol that you had in that fourth quarter into the election and afterwards, post that jumbo rate cut from the Fed. Buyback, $20 billion. This was the missing piece in the chessboard, according to some of the analysts. It was a slight promise by the bank just before Christmas in terms of the narrative from there. Mark Mason hinted that this would be. So $20 billion in a buyback. FICC is a comfortable blowout. And investment banking revenue, $925 million. And again, this is what the market was hoping for, is that renaissance, that change that Jane Fraser has enacted across this bank would be rewarded. Investment banking, $925. The market was looking for $896. So that's a comfortable read for Jane Fraser at Citi this morning. Jonathan.
Manus Cranny, thank you. Citi up by 2.4% in the pre-market. Sonali Basak with us around the table. Sonali, is that a clean sweep this morning? Decent across the board here?
The numbers themselves are very decent. You have them beating on fixed income and trading revenue. You have really strong results here in terms of net interest income as well, above expectations. What investors will also be looking at, John, though, remember, this is a bank that's in the middle of a turnaround story. They did lower their return on tangible common equity targets. The new target for 2026 is now expected to be between 10 and 11%. That used to be higher, between, let me tell you exactly, it used to be between 10 and 12%, I believe. Yes, 11 and 12%. So they are lowering that for next year. By comparison, Goldman is expected to be bringing up in the medium term above 14%. JP Morgan puts up 17% like it's no problem every quarter, right? So that is going to be the number for Citigroup that investors are going to be looking to, because really, with regulatory hurdles that Citi still faces, how can they keep their expenses in line to bring profitability up as they go through this turnaround story?
That I find interesting, that at least for the moment, we are able to get it some decent of a rally, despite the fact that they lowered their return on tangible equity goal, because this had been such a big thing for them. Mike Mayo had said that he didn't think they'd get to their 12% target until 2027. Are moving the goalposts, is this something that investors will be okay with Jane Fraser, who is just so under pressure right now?
Listen, the answer is maybe, because at least you know where they're going now. They're giving you credible targets in terms of what they need to put out the door and what they're going to bring in the door, while, by the way, beating on expectations with the revenue they're bringing in. If they're bringing in revenue and they're showing that they're steadily beating, then maybe it's okay. The point that you made earlier, John, about Janie, you made it, about the models, the business models. They could take on less risk while they partner with private credit firms to bring money in the door and gain client share. They have a new head of investment banking. I think you guys are talking to him very, very soon as well. That will change the game for Citigroup. But remember, the other story for this, too, is they're the cheapest. You have JP Morgan and Goldman Sachs, each trading well above 2 times book value. Citigroup is still well below that. They've made progress, but they have a gap to close here, and investors are looking for them to do it.
Offering some headlines on the outlook here. Let me go through them, Sonali, just briefly. So for revenue for 2025, a range of $83.5 billion to $84.5. The estimate was $83.2. For net interest income, ex-markets, to grow in 2025 modestly. To your point, does that do enough to offset this morning, just rolling back the profit target just a little bit?
The modestly part is a little hard when JP Morgan an hour or two ago said that they're going to bring in $1 billion more in net interest income. They both have massive card businesses. When you hear Mark Mason, the CFO, talk to journalists shortly, but also both of them, Jane and Mark, will talk to analysts soon too. Do they see something different in terms of credit quality? Are they more cautious than their large rival, JP Morgan? Is part of this pressures internationally? Remember, Citigroup has that special concern that a lot of other banks don't have as much of. This is the question.